No matter your age, your plan for retirement can start today. From the News Channel 5 Network, this is the Retirement Report.
Good morning. Welcome to the Retirement Report. I'm Hank Parrott, your host. We're going to be talking about investing again today. This is one of those areas that is probably one of the most important areas, in fact, when it comes to your retirement and being prepared for retirement. It's about saving, investing. Today in particular, when you look at yields being as low as they are, interest rates being held artificially low, in fact, if you will, and what that means when it comes to investing. It's very difficult to put your money into the traditional things you may have in the past, as far as bank money as an example, savings, checking, money markets, CDs, short-term fixed annuities. All of these are fixed accounts. They give you guaranteed amount of interest, so you've got guarantees with them, and they're safe. Unfortunately, you don't earn enough to stay ahead of inflation and taxes, so your purchasing power is going down. So if you're losing your purchasing power, what does that look like? You know, I had a client come in some years ago. He was retired from Ford, had a pension. He had been retired for a number of years, I think over 10 years, in fact. And Ford at that time had went back to the retirees and said, hey, would you like to cash out your pension? And he came in to crunch some numbers with me and to determine whether that would be in his best interest or not. Well, one of the things he shared, he says, you know, when I first retired 10 years ago, he said, between my pension, Social Security, he says, I didn't even have to touch my savings. I was able to live on that quite comfortably and maintain the lifestyle that I'd grown accustomed to. He said, but now I'm finding that I'm having to dip into my savings more and more every year. And he said, that started a few years ago. He says, and I'm kind of concerned about that. And of course, the reason is that pension didn't change, right? It stayed the same. There was no cost of living adjustments. It's just a flat number. And that's the way most private pensions work. So if you even have a pension, right? Now you've got Social Security, you got cost of living adjustments there, but typically that's really not staying up with what you're seeing in terms of the things you spend money on when you're in retirement, like increasing healthcare costs as an example, which goes up much higher than what we would normally see with the CPI, Consumer Price Index. So here he is, concerned about his purchase. This is a real life example of how his purchasing power was being reduced on his money. Now he was having to use more and more of his money, right, which put him at risk, just to cover his same expenses. He said, I'm not doing anything any different. I'm buying the same things. I'm having the same lifestyle, but everything's gone up in price, and I'm having to dip more and more into my savings. And of course, that puts him at risk, especially if those savings are just sitting in a bank. That's putting him at more risk to running out of money. This is why we're even more today than ever having to invest in the market as one way to stay ahead of inflation and taxes. Now, the ways to do that safely, how the smart money invests, I talk about in 7 Steps to Financial Freedom and Retirement, and I've talked to you many times over the years about how to use modern portfolio theory as a way to reduce your volatility in your portfolios while still seeking out that market return, that needed rate of return, in fact, to accomplish your financial goals. So today we're looking now at what's the world, how has it changed? Right, we're seeing, of course, again, interest rates are very low. We've had the concerns, of course, with COVID, with the pandemic over this past year, and what effect that's had on the markets, what it's had on our economy, on our country, on our life. Right, when we see what's happened with regard to the amount of jobs lost. So what's happening today? Well, we're going to dive into that as well and talk to you about its 1-year anniversary just a couple of days ago of the bull market. And we're going to get into that a little bit and what's happened in this past year. And joining me today in that discussion is Jeremy Rettich with Virtue Capital over in Brentwood, Tennessee. And Jeremy and I are working closer and closer together. He's got some great product over there, some great strategies that can be employed with regard to portfolios. We've incorporated two, which we've talked about and we're going to get into today as well. One of those being utilizing TIPS today and Treasury inflation protected securities. We're seeing inflation go up. We're seeing a premium then being added to that return. So there's a safe way to get some additional yield on our fixed income. Another we've talked about is equal weight equal weight index, and there's this fund for that, and this is one of those areas we're going to dive into a little bit as well. And Jeremy, this is one of those, we've spent some time talking about market weight indexes, equal weight indexes, and I'm not sure how they play out just in this past year. Maybe you'll know on that, but the 1-year anniversary of the bull market, why don't we get that slide up, Marilena? This is that first one, and we can talk a little bit about how that's occurred over this past year. So we have that slide. There we go. So Jeremy, why don't you talk about this a little bit? It's pretty impressive when we think of how much the market dropped in such a short time and then what's happened since then.
Yeah, so as you'll see here, what we experienced last year when we hit the peak on February 19th, we saw a 22%, we saw a 34% decline in 22 trading days, down 34% in 22 trading days, fastest 30% decline in the history of the stock market, outpacing the decline that we saw during the Great Depression. And then we saw later on in the year, so that was a bear market, as you can see in the pink there. We went down to March 23rd and we hit a bottom and started to come back up. And then in August, we hit again an all-time high. So that was the fastest 30% decline that you can see in 22 trading days, and also the fastest recovery from a bear market in the history of the stock market. So definitely a very volatile year that we experienced last year. When you look at that, Hank, you had said a couple of things when you teed up what we're going to talk about today that I wanted to touch on. Inflation is often called the silent tax, right? Because you don't see it, but it's there. And when you look at your financial plan, if you don't have an income plan, you need one. And if you do have an income plan and you're not factoring in taxes and inflation, you're doing yourself a disservice, because both of those things are going to erode away at what is going to hit your account and what's available for purchasing power. So you definitely want to incorporate both of those things, which brings me to talking about this chart in year to date, Hank. You know, you want to definitely make changes in your portfolio from time to time. It's not a set it and forget it type of process. Equal weight, for example, has outperformed market weight by more than double. Year to date through close yesterday, market weight was up a little over 4% for the year. Equal weight S&P 500 index was up almost 9.5%. So big difference.
Yeah, and this is one of those areas when we're looking at market weight versus equal weight, and it's not, as we've talked about, Jeremy, this isn't something, and it's important for our audience to know that when you're, as you're listening out there, this isn't about going out and saying you should change from an S&P 500 index fund and go out and seek out an equal weight index. All right, what we're talking about, in fact, is how these blend together. When we talk about modern portfolio theory, and I've shared many times about how the smart money invests and the concepts behind market portfolio theory, what Dr. Markowitz, who won the Nobel Prize back in 1990, considered the father of modern portfolio theory, in fact, what he showed in his research was how we're looking for asset categories with negative correlations, simply meaning that when one's up, the other's down. Stocks and bonds are a prime example of that. So typically when stocks are on a run, bonds aren't keeping up. When stocks go down, bonds are what help soften that for you and reduce your volatility or the amount that you might lose, and helps give you a little bit of return at the same time. So this is where with modern portfolio theory, we're talking about this negative correlation. What else might work for that? This is large companies and small companies, growth companies and value companies. And here's where we're bringing together different asset categories that are going to behave a little differently. And in doing so, and under different market conditions, the goal is that we're going to smooth that volatility and while getting that market return. And that's what we want to do. We want to tighten things up, reduce the risk, while getting a market return, determining, of course, first off, as Jeremy, as you said, with regard to the income plan, when it comes to that planning, how this fits in, we first start with determining what is the needed rate of return on your money that you need, right, to accomplish your financial goals. First and foremost, to attain and maintain your standard of living, your quality of life, no matter how long you live, never have to worry about running out of money. And then in all financial goals, that's not just the getting by, right? We don't want to just survive rather in retirement. We want to thrive. We want to be able to have fun. So when I talk about discretionary spending, I refer to it as fun money. You know, the types of things, the leisure activities that we enjoy, how we can make the most of that. So when it comes to the investment side, it is one piece of the puzzle. It starts with getting a comprehensive plan together. What's the needed rate of return? Now we build an investment plan for your specific needs, and of course based on your risk tolerance and all your financial goals. So when it comes to that, that's why we look to blend together a bunch of things, because first and foremost, in determining what the needed rate of return is, how do we put the investment plan together to accomplish that goal, to hit that needed rate of return, and at the same time we want to reduce risk, right? And that's going to give you the peace of mind of being able to stay invested. It makes it easier to stay more disciplined, which is so important when it comes to your planning and to your retirement years. So equal weight is just another thing added in. Under different market conditions, it's going to outperform. And in fact, when we come back, we're going to talk about just how that works, how it outperforms, and in fact, over the last 70 years, how has equal weight index, the equal weight index compared to a market weight index, how have they fared? How have they compared? First a break. Join us here. We'll be right back on the Retirement Report.